I'm going to run through, again, as I mentioned earlier, we'll go a top to bottom approach, talk about the US economy, what I see going on there, distill it down then to talk about regionally what's happening. And then beyond that, obviously, what is the topic near and dear, certainly to my heart and to Windermere's, which is what's happening in the housing market. So to start with, it's a very unique world in which we live. And this has caused a lot of angst, certainly for economists, as it has for the country in general. What essentially we did when the pandemic really kicked in early March is turn the economic lights off. And if you imagine the fact that 70% of the US economy is consumption, it's us buying things. And when we are prohibited from doing so, the world stops. But what is important to understand is the fact that the economy in March, actually in February, was actually in remarkably good shape. We were adding a couple of 100,000 jobs per month, unemployment rate down below 3.5%. So even though when you normally see a contraction or a recession, there are normal reasons for it, this was very, very unique. But as we look forward, the issue I'm seeing today is this. We've really got new infection rates going parabolic in much of the country. And it's actually specifically occurring in several states, in California, Illinois, Wisconsin, Texas, who are the leaders. Now, we are certainly, I'll talk more about locally a little later on. We are doing better than them, but it's certainly not good. And I do anticipate that through the course of the winter, it's probably going to get worse. And to give you an idea, we've had over 100,000 new cases per day for the last week. And these are levels we've never seen before. So I think in a lot of respects, do I expect it to get worse before it gets better? Unfortunately, given the time of year, I fear that it will. But we will get through this at some point, but the impacts on the economy have been very significant. Talk about growth, and growth's interesting. And obviously we've heard a lot the last few weeks when they announced GDP for Q3, massive jump, 33%, coming off that 31.5% contraction. And again, the reason why you saw this contraction is because most of the US economy is revolved around consumption. And we essentially stopped. Yes, was it record breaking on the downside and record breaking on the upside? Absolutely. But I think there needs to be a bit of perspective. We would have needed to have seen growth above 45% in order to get us back to pre-COVID levels. So are we there? We're getting there. However, it is certainly not, we're not there yet. So, but certainly certainly significant improvement. And I do believe that that should continue as we progress through the year. And ultimately, when we see an inoculation or a vaccine. And the growth we saw was really all around consumer spending. It was up by almost 41%. Durable goods orders were up. Why? Because we're actually going out spending money on fridges and on furniture. And clearly the residential sector has helped significantly. Jobs, we lost a lot of them, and really quite remarkable. Now this looks at the overall jobs losses over time. And on a monthly grain, I mean, almost 21 million jobs were shed in 1 month. We certainly did improve as we came out of it in May and June. However, and you can clearly see the significant slowdown we've seen, 680,000 jobs in October was really not what I was hoping for. But I'm not expecting to see much in the way of an additional bounce back as we go forward. But to give you some kind of idea what this means, if you go back to late 2010, between October 2010, February this year, we added about a bit more than 22 million jobs. We lost more than that many in 2 months, let alone 10 years. But as we start to see that improvement, you see it occurring, a reasonable snapback, V-shape, probably not really. In fact, most of my economist friends, we've come up with a new shape for it, Nike swoosh shaped, which means kind of very sharp out to start with and then gradually tending to trail off. But jobs are certainly returning, but they're not returning in all sectors. Now this looks at the job losses and the job recovery. Job losses in a couple of months and recovery subsequent to that. We are still seeing significant issues, specifically in the leisure and hospitality industry. Hotels are hurting, and they are going to stay that way, I would argue, for quite some time. And even when we start moving around and even when we come out with a vaccine inoculation, it's quite likely that you'll go to your favorite hotel and you won't see anyone at the front desk. You'll be checking in on your phone. Your key will be sent to your phone. So those will be jobs that won't come back. Additionally, food and beverage services will also be contracting quite significantly. Now, you might look at this and say, well, hang on a second, education, health services, why is that? Mainly it's actually around health and it's ambulatory health care. We are still not going back to the doctor's office, not going back to the dentist, these kinds of things. So we are seeing some improvement, but it is going to take some time. But it really has become bifurcated. A lot of the service sector jobs will take a lot longer to recover, however, and manufacturing to a degree. But if we look at technology, these kinds of things, that's actually, I think, going to continue to recover quite well. Government was down for really one very simple reason. Census takers, a lot got hired, a lot have just been laid off. In my forecast, we'll probably add about, in the third quarter, well, we did add about 1.3 million jobs per month, but you can see here as we move forward, the balance of next year, we're going to slow down. Now, historically, we were in that 220, 250,000 jobs per month. We will be above that even through the end of next year, but it is going to take quite some time to get back to the employment levels that we had seen. On the unemployment basis, weekly unemployment claims. What happened recently has made us economists kind of mad because it makes our charts look remarkably ugly. These are new unemployment claims which come out weekly. Way on the left, that tiny little blip, that was the Great Recession. We thought that was bad then. Spiked significantly, but it is getting a bit better. The top chart you show here is weekly new claims, initial claims, and below that, continuing claims. And continuing claims are more than 2 weeks. Trending down, however, still elevated. Unemployment rate at 6.9 in October was a reasonable number. I look at the lighter blue line at 12.1. That's the real unemployment rate because it includes people who are unemployed, but who haven't actively looked for a job in the past 4 weeks. Now, if you look at the U6 number back in April, that was a figure at about 23%. Last time we saw that, well, that would have been around 1938. Middle of the Great Depression. So this gives you an idea as to how bad we got for a fairly short period of time. But again, as we go forward, that rate will continue to contract. But gentlemen, ladies, this is going to be a long time before we get back down to that 4% full employment rate. We will not see it next year. I'm hopeful that we will probably by the end of 2021. A lot of people are concerned about inflation right now. We know that Federal Reserve and Chair Powell, they've turned on the printing presses again in forms of monetary easing. Obviously, fiscal policy adjustments have been made in order to provide some stability underneath the nation as we move through COVID. I'm still not seeing any reason why we'll see a significant spike in inflation. However, Chair Powell has certainly said recently that the original goal of the Fed, which was to keep inflation at 2%, he's now prepared to see that. He's looking at a longer term trend. So if it gets up above it, he's unlikely to make any changes. And quite frankly, there is relatively little he can do right now, given the fact that interest rates on the Fed funds side anyway, are essentially at zero. We are not, however, going to go to a negative interest rate environment. That doesn't work. Most economists agree that it won't. So we're not going to go there. So that actually, to a degree, does limit the tools that he has. However, at the same time, are we printing more dollars? Yeah. However, the dollar's strength is still essentially there. And mainly for the fact that a lot of people don't really understand is that the US dollar is the de facto currency in about 38 countries across the planet, or around the planet rather. So there is still significant demand. It is the de facto global currency. So we see a lot of demand. So even if you're expanding the money supply, I'm not overly concerned. Banks, however, from a business side, are they cautious in their underwriting? Absolutely they are. This is the net percentage of lenders of banks who have significantly tightened their lending criteria for commercial and industrial loans. So whether you're a small shop or a larger one, it is still very hard to get financing. And relatively speaking, that's unsurprising, mainly given uncertainty. I do, however, believe that that will start becoming a little easier. But again, we're not going to be down at the levels we saw before the pandemic hit. And from a real estate standpoint, even more so. And there are a lot of worries in real estate and commercial real estate. Mostly that revolves around office. And I'm concerned about that. I'll talk about that a bit more later on. Industrial as well. If I have a biggest concern on the commercial lending market, in fact, commercial real estate in aggregate, it is around hotels. We have the CMBS, commercial mortgage-backed securities market, i.e. mortgages on motels and hotels. It's about $500 billion, and they are hurting. We have actually seen vacancy rates for hotels in America now drop back down to about 48%. Now, it's not as bad as it was, about 20% in April and May. It's getting better, but it is still very hard for them. And naturally, because of that, lenders are becoming increasingly tight. I like to look at a more unusual index. This is a small business optimism index. And it's interesting, you can see here, classic V, dropped down, started to see improvement. However, the index level in October matched that that we saw in September. So we're finding some more caution there. But when you dig, or when I dig into the numbers, there are some fascinating nuggets you can get out of it. They ask a lot of questions to small businesses across the country, and there are some which are a little bit surprising. Now, when they talk about net share, let's say the net share of businesses planning to add staff, it means that you take the percentage of respondents who plan to increase minus those that plan to decrease. So it's a net share. But most of these are positive. A lot of companies, 1 in 5, believe they will be adding staff shortly. 1 in 4 will be making some capital outlays. They're going to be spending some money on either their facilities, on machinery. And again, about the same percentage believe that we will see a significant improvement to the economy over the course of the next 6 months. On the other side of it, credit conditions, we talked about that a few minutes ago. That is still hard for them. However, there's a reasonable number that say that it's a good time to expand, which that again for me was a little bit counterintuitive. Earnings haven't risen, but that bottom one is fascinating. 27% on a net have had to raise compensation. Businesses still looking to attract good talent and keep good talent. That was something which surprised me a little bit, but when you think about it, it does make sense for a lot of the companies that have been, shall we say, somewhat less impacted by COVID-19 than others. So I look at this optimism by businesses. Certainly it's more of a glass half full scenario than a glass half empty. So I talk about the US economy. Certainly massive amount of weight is being given on a vaccine or an inoculation coming out this winter. But I do have a couple of questions about it. One of which is it's going to be a distribution issue. We know that there's a lot of us in the country that need it. How are we going to get that out there? Also, the University of Oxford, the one group that are closest to a vaccine, is going to have to be kept at remarkably low temperatures, 85 degrees below zero. That's a problem unto itself. But I would say the biggest issue that I have is, are we going to take it? Normally on these scenarios, a new drug takes 5 to 10 years, not 5 to 10 months. And I will tell you one thing, I will take any vaccine or any inoculation the day that Dr. Fauci does. So if we think about it in those terms, that's going to be a positive. But certainly the belief is we will. Now there's right now 8 companies in human trials. University of Oxford, my alma mater, is getting very close. Also is a group out of the University of Washington, go Dogs. So I think that we will see something, but a lot of weight, certainly from an economic standpoint, is being placed upon the fact that we will go out again. We will start interacting and we will kind of create that social contract that we do when we go out to a store, with the belief that you can go and talk to somebody and you're not going to get infected with a disease. Not all jobs will return. We're certainly seeing the furloughs, the temporary layoffs turning permanent. And again, that is very specifically hitting that leisure and hospitality, the hotels, the bars, the restaurants. And I say restaurants, which is interesting because it's quite likely in the future you will go to your favorite restaurant and you'll find fewer tables. And if there's fewer tables, fewer covers, and less people, which means the need for less waiters, less waitresses, and ultimately less cooks. So I would not be surprised to see some of those jobs not coming back, and those people therefore will have to retrain. And secondly, it's in the retail world. The retail environment's been fascinating. It's been, again, very bifurcated. Online shopping, if you own a share in Amazon, congratulations, you are killing it. That online shopping is doing remarkably well, as is grocery store shopping. Apparently, for some reason, we need to have a year's worth of toilet paper. However, the Main Street retail is very hard. And those are companies that have had to stock their shelves. They've borrowed money in a lot of respects to do that. They have to service that debt. And if we're not buying their products, that makes it very, very hard for them. And a lot of them are getting very close, quite frankly, to failing. So I would say to all of you, where you are allowed to, where possible, spend money in your local businesses. It is going to be remarkably important, not just here, but across the country. I think we'll continue to see some reasonable income growth, mainly based on the fact of businesses that were less impacted, still understanding that their life goes on, whether they're working from an office or working from their homes. So we will see some income growth, which is almost counterintuitive when you find the unemployment rate as high as it is. We tend to see income growth really tend to stagnate, not expecting to see that next year. We will see some real growth, but without a doubt, as Gary mentioned earlier, the election is still weighing on businesses' minds. I think that Wall Street has pretty much come to terms with the fact that we will see a change of administration, and to a degree they like it. And here's why. I know, as Gary also said earlier on, that we will not know who controls the Senate until we see the outcome of the runoffs in Georgia. But if you go back in time, both from a stock market standpoint, let's take the S&P, or you take GDP growth, the country actually performs better than average when you have a Democrat in the White House and a Republican-controlled Senate. So if that is going to be the case going forward, I think that's the bet that Wall Street is making. But I think a lot of companies, no, certainly Wall Street doesn't like uncertainty. It really kind of upsets them. And so until we get really come through this, which we will not know ultimately until sometime in January, that is still going to act as a bit of a weight. However, I certainly expect that in general that Wall Street is fairly comfortable with where we are right now. Talked about national, let's talk about regional, the regional economy here. Washington State, new COVID cases spiked again. We saw a bit of a drop off last week, but it's still higher, far higher right now than you'd like to see it. And certainly it's almost at a third peak. And without a doubt, the governor and the administration in Washington State is looking very closely at this, and they will have no compunction at all. I'm not saying they're going to shut down the state again, but to slow down the reopening if these numbers continue to rise. And this is across the state. And actually what we find, or I'm seeing, is that certain pockets are doing worse than others. East of the Cascades certainly is doing that, but even parts of the central Puget Sound are not behaving, whereas others are. In the city of Seattle, where I live, new cases are down below 1% of population, but further down to the south, let's say in Auburn, they are significantly higher than that. And Gary did mention about where you are in Whatcom County. Well done. These are new cases by week. And I pulled the numbers that dated through, I believe, the 1st of this month. So you kind of have to squint a bit. You can see the peaks. Obviously, it's relatively speaking small. As long as that line's going down, that certainly makes me feel a little bit more comfortable. So I think you're behaving well. Congratulations for that. We look at the jobs lost across the metro areas in Washington State. Clearly, most of the jobs shed were in Seattle. Then obviously in Tacoma, understandably, the two largest metro areas in terms of a job base. You lost up in Belling, about 14,300 jobs were shed. Remember, this is in a 2-month period. But once we got through April, you've recovered 10,000 of the 14,000 jobs lost. Still, you're down by a third, no question about it. but you are seeing a tangible improvement. And quite frankly, we are everywhere. Down south, Longview, not so much, and Wenatchee, which is unsurprising, very small economy. But in Bellingham, you are getting those jobs back. And now what are those jobs that we're seeing return? Again, this is Whatcom County. Massive recovery in retail, which I thought was really quite interesting to look at. We've seen we're still down in leisure and hospitality, understandable. And in fact, we saw a significant number of jobs lost in September. But across most sectors, transportation, utilities have not recovered all those jobs. Some recovery in manufacturing, that's good. Obviously, construction is good to see as well. So it is certainly bifurcated, but we are seeing most sectors start to recover the jobs that had been shed because of COVID-19. On the unemployment side, unemployment rate, you peaked, as with everyone else, at 18%, a quite extraordinary number. Down around 8.5 now, still higher. I'd like to see that number fall further. But in essence, most are doing well, and the Yakima Valley still significantly more elevated than anywhere else. But the trend pretty much across Washington state is heading downward. And when we talk about your immediate area at 8.5, it's still that trend has dropped down, but you're still basically twice as high as you were before the pandemic hit. So March was okay, but then obviously you, along with the rest of the country, really went kind of parabolic. And if we look at initial claims for unemployment, still elevated, but doing far better than you were. And that is certainly a very good thing to see. And I do anticipate that over time through the winter, most sectors will continue to recover, not all. And as you see that occurring, then you're going to continue to see those initial claims for unemployment continue to drop. Demographics is always very, very important. And I like to look at demographics in a bit of a more unique way. And it's this. In essence, this looks at births in the county over time, going back to 2010. So you can clearly see here, on average, somewhere around between 21 and 2,300 children are born every year up there. And then you subtract from that people who are dying, and it's not very pleasing to see. You're seeing as many people dying as there are being born. There is a reason for that I'll get to momentarily. So if you take births minus deaths, that gives you a net, and you're really not growing in terms of just the natural rate of growth. However, you are, and here's why. People are moving there. Now, these are numbers through April, so they don't account for effects of COVID-19, which again, I'll get to shortly. But really since 2014, parabolic increase of people clearly moving from somewhere else into the county. And when I run those numbers and I say, well, who are these people? You tend to look at population by age. And this is my forecast for the next 5 years. You are going to see some increase in younger children, but the major increase is in that older population, not so much in absolute numbers, just in a percentage growth. So you're really seeing some fairly reasonable growth, and also in that prime starting to create a family, which is going to be up by 11.5%. And quite frankly, that 25 to 34 age cohort is in absolute terms the largest. That is a significant positive. Means they're creating families, that's going to create spending. These people are going to be working in your area. So these are actually numbers which I find very pleasing. And this is obviously through the course of the next 5 years. And on the income basis as well, don't look at the left-hand side of the chart. Obviously, over time, given inflation, you see contraction in lower income households, but significant increases in that $75,000 a year and higher. And I do expect that to increase, and certainly even more so in that $100,000 to $150,000 a year. A significant positive for the local economy as much as everything else. So over time, I think that you're going to see population growth, not just from the people moving in, which the chart I showed you earlier, but I do believe that we'll see more people, and especially those moving out of the urban centers. We're starting to see it already. We're seeing it certainly in people moving from King County. Without a doubt, a lot of them already up into Snohomish County. I think they will also, to a degree, start to move further north. Skagit County to a lesser degree, but certainly up into around Bellingham. I mean, it certainly offers a a very interesting one, local economy. Plus the fact I love coming up to your neck of the woods. It's a great place to be. And we are also seeing growth in retirees. Maybe that's part of the reason why you're seeing increasing number of deaths. Why are people retiring to Bellingham? Drugs. No, it's not those kinds of drugs. You can get those anywhere now. They're coming up so they can go across the border into Canada to get their prescriptions filled. So we're seeing a fairly active amount of retirement moves coming into your county, mainly because of that need for medication. On the economy, I mean, it is uncertainty. We don't like it. Economists, it does drive us to drink. We like predictability, as does any normal economy. And we are in a remarkably unpredictable situation. I think when I mentioned earlier on about the migration of people coming out, I think a lot of people also believe that this current pandemic, as much as we haven't seen anything like it since 1918, is not going to be the last. We will see more of them. And I think because of that migration away from urban centers is something which is not surprising. We are likely to continue to see that. But we are also likely to continue to see companies say, you don't have to be in an office, you can work remotely. And if they do that, that allows people to move out of these dense urban areas, which are remarkably expensive, and say, this is great, I'll sell my house in King County, move up to Bellingham and either pay all cash or put down a very, very significant down payment. If they're allowed to do that from that working remotely, I think that is something which I believe is going to continue. I do not believe that it's just an anomaly. Now, don't forget, we did try this before. Back in the early 1990s, I was actually teaching at Harvard back then. And the whole goal was that working from home was going to be the panacea. It was going to solve all of our woes, transportation issues, all these other problems. And it didn't work. And it didn't work, quite frankly, for two reasons. One of which was that employers thought that their employees were watching daytime TV and not working. Well, you can catch them on Zoom now. You couldn't do that back then. So we know that's not the case. But employees didn't like it because of that. They missed that symbiosis of discussions around the water cooler. And that is certainly still the case. But I do believe, unlike what we saw 20 years ago, that this is a real situation now, and it is going to continue over time. It's not just going to be a temporary adjustment. Again, you've recovered 10,000 of the jobs lost. Some sectors that I've talked about are going to weigh on that total recovery, which will unlikely come until some point next year when we feel more comfortable and we believe that our own worlds are back to normal. But demographics out there are still very favorable. Next year will be better. I have no doubt about it. I think you will get those jobs back. I think we will have a vaccine or inoculation. We will feel more comfortable going out and spending our money again. We still continue to see fewer people coming across the border when they're allowed to. I know that Canada still has banned us from going up there. But even when that reopens, we certainly saw a lot a couple of years ago. Funny, when I was giving speeches for our offices up in Bellingham, I was always interested as I drove north on I-5 to look at the malls and basically count the number of Canadian license plates. That was a big tell for me. It's in a similar way down here that I used to go out to Boeing Field and count the number of tails on the field. But what's changed basically was the strengthening of the dollar made it more expensive, and that has curtailed certainly some investment from Canadians coming across the border. Will that change? If it does, that's fine. If it doesn't, then I think we will still survive. But without a doubt, irrespective, next year will be better. On the housing front, I'm going to start off with actually mortgage rates because it's very important. Mortgage rates are we seem to be breaking lows on a weekly basis. 30-year hit another all-time low last week. The 15-year fixed mortgage rate matched its all-time low. A lot of demand for bonds because of volatility in the equity markets. That is essentially what's driving mortgage rates down. And I find one thing, I'm probably getting in too deep here, but the relative advantage that used to be in existence from having an adjustable rate mortgage over a fixed rate doesn't exist anymore. And that is quite remarkable. And as we go forward, we might get above 4% in 2022. Now, I don't think any of you are old enough, but I remember mortgages back in October of 1982 were at 20%. It's just amazing. So this, again, is what's been driving the market. Rates are going to rise as we move forward, but still remain remarkably attractive. And that obviously is going to allow home price growth to continue. But the problem we have is this. The number of homes for sale is at a ludicrously low level. And we are at a point that I've never seen before in Whatcom County, quite frankly. And because it is so low, and there's very simple reasons why it's low, we're living in our homes for about twice as long as we used to. Even when we change jobs, and for a lot of us, we're still not going to move house. We will stay local to our area. And given those two things in concert with each other, and we're not moving, we're not seeing that turnover, active listings are very low. And because they are so low, home sellers, well, list prices now, you're knocking on $750,000. That's the average list price for a single family home in the county. Really amazing. And because there is significantly more demand than there is supply. It really is economics 101. Yet at the same time, we're still seeing demand. You see a classic V that we saw here in terms of sales. Fell off a cliff when COVID-19 hit, jumped back up very, very nicely. So that demand does suggest, again, to me, people moving into the area. We're seeing that turnover. That's a good thing. Inventory is low. But the trouble is, as we have this demand and remarkably low mortgage rates and limited inventory, home prices have jumped. We're down now just below $550,000. It's still a very, very high figure, and one you haven't seen even before the housing bubble burst at the end of 2007. And from a demand perspective, the long-term average, going back 15, 20 years, you tend to sell about 2,300 homes per year. You've broken that already. There's still 2 more months to go. I don't think you'll quite get to last year's number, but it won't be through a lack of demand. It will be through a lack of supply. And when we look at different markets around the area, and this is price growth, this looks at median sales price in October of this year versus October of last year. All of them are quite extraordinary. All, I believe, in double digits. Yes, they are. So is this sustainable? No, it is not. I do not like to see any housing market anywhere going up at north of 10%. In fact, I'd like that to be down in the mid-single digits, preferably. However, we've been able to do it on the back of mortgage rates, which have dropped down by over 1.5% over the course of the last couple of years. And it might sound great for all of you that own your homes. This is wonderful. However, that might be a good thing. But at some point, as Gary did mention earlier, affordability starts to become an issue. And guess what? It is an issue. At the University of Washington, we put this a study we put out every quarter and have done so since 1992. And it looks at housing affordability, all buyers, which is the light blue line, and first-time buyers. You are technically unaffordable. Now, I believe I heard earlier on people talking about the medical center there having a problem attracting doctors. Absolutely true, given housing prices. And I think this is something we need to look at regionally, not just locally. And here's why. Because at some point, businesses, if they're thinking about expanding, let's say, into Bellingham, what are the 2 most important things that they think about? Well, one is there a talented workforce I can hire? Oh, check that box. You guys are wicked smart up there. Got that. But the second component is how much do I have to pay people? And the biggest component of salaries is obviously cost of living. So unless this can be addressed, then at some point, although not yet, it's going to start becoming harder for businesses to grow because of the lack of housing based upon housing price. However, unfortunately, or not, or fortunately, depending on what side of the coin you are, you're going to see prices up year over year by 11% this year and up by almost 7% next year. It's still well above the long-term rate that we saw in that marketplace. So price growth is going to slow, and it has to as a function of affordability and mortgage rates starting to rise. You are doing well. I think you've got a vibrant urban economy there, semi-urban. That is going to continue, I believe, to expand. But the problem is a lack of inventory. And when we talk about lack of inventory, we need to look obviously at new construction. But we'd only get this data annually. I wish we got it more frequently, but it's not reported for Whatcom County, unfortunately. So you're well down from where you were before the recession, but I know that there's plans for some fairly significant housing development that hopefully will occur over the course of the next, around Blaine, over the course of the next kind of 10 or 15 years. That will be a positive, but right now you're not providing enough, there are not enough lots being permitted. And because of that, dark blue line of supply, next to none, but you still have got that demand, which really is very interesting to see. But what we have seen also is builders, knowing where price points are having to become more competitive. And I say that because I like to look at the spread between existing homes and new homes. Take the 12-month average and calculate the ratio there. And so what builders have done is they've either gone to look further out to cheaper land, or they're building a different type of product, because a 5% spread between new construction and resale is remarkably low. Because if we go back, average since 2005 has been about 11, 12%. So it is significantly lower than that. So they are becoming more competitive. The trouble is fourfold when it comes to builders. One, it's going to be based around land. Land prices continue to escalate. We're not making any more of it. Two, labor. No one is learning to become a plumber, a carpenter, or an electrician. No one's going to vocational schools. And because of that, that puts upward price pressure on construction labor. Third, hard costs, material costs. We'll tell you one little nugget. The price of softwood lumber to build homes has risen since April by 174%, an extraordinary figure. Partially, it's due to the ongoing forest fires. We know that warehouses are suffering because of, right now, they're being hit in their lands in Oregon and Washington. They've got about 2 million acres. But also, we are actually taxing lumber coming down from Canada, the Canadian softwood lumber tariff. But it's not just that. We're taxing other things as well: copper, steel, aluminum, mainly because of trade wars with China. And so all these things combined are pushing up material costs. And finally, regulatory fees. 25 cents of every dollar it costs to build a home in America are regulatory fees. So when you combine all those things, builders want to build. That's their job. However, if they figure out what their land costs, what it would cost to build a house, and let's say that spits out a number of $800,000. Okay. Well, if the market price acceptance point is 600,000, are they going to build it? No, they won't. And certainly given how tight construction lending is today. But from an overall demand standpoint, there's about maybe more than 55,000 current home owners in Whatcom County. My forecast is going to grow by 6.5%. You're going to see demand for at least over 3,500 new owner households being formed. You're not building enough. It's quite as simple as that. So if you're not building enough and you've got that net new demand, that's going to do one thing. It's going to put further upward pressure on pricing. And on the housing side, yeah, home prices, they will slow on the growth side. That pleases me, believe it or not. I just don't see it happening yet. And I think that that's going to be the case through the course of next year. Affordability. It's going to be very important for those of you up there involved in this to try and figure out how you can start enhancing that, create that affordability. If you're able to do that, you will attract one more residents, two more businesses to come up to Bellingham and the Bellingham area. And we will see some new development. That's good. It will take some of the stress off. Unfortunately, not going to be enough. Yes, the move from urban centers, it's not a myth, and nor is it just a fleeting scenario. It is going to continue, and people will look, and not just moving up to Snohomish or down to Pierce County. They are going to come up further. They are going to come up further north. Less so, I'd say, down south into Thurston County. So I think you have the potential to benefit from that, absolutely. And yeah, it's going to be a significant positive for the housing market. So I think in closing, before I open this up to questions, I believe that the recovery we're seeing in Bellingham and the county as a whole, it's real. I think that the growth or the recovery will continue to slow until we have a vaccine or an inoculation that is in place, that is freely available. That is going to take some time, likely into late spring, early summer of next year. I think your local economy can continue to expand if you can fix the housing issue, and that is mainly around affordability. I think your population growth, yes, the natural growth has slowed. We know that. but that in-migration is what's going to be driving your economy as you move forward. And with that, I would be delighted to answer any questions if you happen to have some. And I will stop sharing my screen.
Very good. Matthew, thank you for that presentation. And I would hope that that the slides could be forwarded and shared with us. Is that,
absolutely, yeah. My assistant will send you a copy of the deck later on this afternoon.
Great. So here's my drill down question. There is, first off, and I have 40 years history in the community, both as a developer and also as a planner, professional planner. I managed several projects to get built. So my overall comment is there is a significant effort within the city of Bellingham jurisdiction, which is inclusive of the urban growth area around it, that continues to restrict the available property for various housing forms, for single family, and then you can take it out to townhouses, et cetera. But the big picture is, except for multifamily, your 3, 4, 5-story apartments, other housing forms to the family types that you've profiled within the demographics, there is not product being produced for them. So the result is you have the buyers looking out into the outward cities, Blaine, Fairhaven, Linden, Ferndale. I didn't mean to say Fairhaven, sorry. Blaine, Ferndale, Linden, and others. And so my question is this: given that restrictive atmosphere we have in Bellingham, and the pattern is more growth in the non-Bellingham locations, do you anticipate that those smaller cities have the capacity to absorb the type of growth that you're projecting here if Bellingham continues this restrictive policy?
I think so much of it is going to be down to infrastructure as much as anything else. It's very easy to say, and a great question, Bill, thank you for it. Is there capacity for that growth to occur in these smaller areas? I think ultimately, what's fascinating, I find, just in general, is that zoning was created in Washington State in 1938. So it's been around a long time, and it might have made sense then. However, does prevailing zoning today make the sense it did 70 years ago? I would argue, no, it doesn't. And I always use the same example on this. And I know it's not in your area, it actually is in Seattle. The city of Seattle itself, our major urban metropolitan spot, 70% of the city is zoned single family. Is that appropriate? Not even close, but it is what it is. Now, does it need to be changed? I would argue, yes, it does. However, what we found is that there's a very significant pushback from existing residents who are saying, we want to embrace kind of all manner of housing. It's great, just don't build it next to me. And I said, here, I live on Queen Anne Hill, and they're doing some rezoning down on Mercer Street. And some of my neighbors are up in arms. They might lose their Space Needle view. Oh, the humanity. But the trouble is that my neighbors are lawyers for Kennel Gates, Perkins Coie, Davis Right to Remain. They'll fight it pro bono. And the reason why I'm saying this is very simple, is that we know that we will not expand our urban growth boundaries. These were set in place in 1990, ratified by all 38 counties in 1993, which basically defines where you can and where you cannot build. Outside of the urban growth boundaries, it's 1 house per 5 acres up to 1 house per 20 acres. So what I believe is necessary is we need to look inside those areas. And we know that already Minneapolis, Minnesota has already adopted a plan that you can build denser product inside single family zones. So single family zone, you can build duplexes, triplexes, or 4-packs. And it's a new program. However, it is also one that has been adopted by the state of Oregon in its entirety. Now, it doesn't kick in until May of 2021 outside of the MSAs and May of 2022 inside them. But I think we need to start understanding the fact that, and for Bellingham City itself, look at your zoning. Does it make sense? It might have done before. Maybe that is not the case now. If you don't do that, then absolutely, you will see people moving further out. But what will potentially hobble that, quite frankly, is nothing more than infrastructure. If the infrastructure in these more lesser urban areas is insufficient, that's going to make it very hard for a developer to grow there to the capacity that he wants. Now, we know in Blaine that there's a program or plan for a large number of housing units over the course of the next couple of decades, and that's fine if that happens. But Bellingham itself, my advice would be, let's start looking at your prevailing zoning. Let's see if it does make sense. But you may well find the same pushback that we're finding down here, where we have these NIMBYs, NIMBY being an acronym for not in my backyard. And we need to turn these people around to start saying, no, we need to sort of embrace a little bit more density. So I'm not saying you need to start building tower blocks everywhere, absolutely not. But let's just look at it and see if the zoning you have in place is as appropriate as it should be. You are suffering growing pains up there is no doubt. And that means you either got to evolve and change or get left behind. And so that is would be my brief suggestion is within the city limits itself, just take a look. Does it make sense? And if it does not, then I'd say, that we probably want to start looking at it a different way. Now, Lyle, you were saying that GMA is more than the UGB, and you're absolutely right. But can you expand on that statement a little bit? You need to unmute yourself.
Sorry, to expand on my statement?
No, Lyle just said, sorry, I'm sorry.
Sorry.
I hope, Bill, that answered your
question. Yeah, I think the bigger challenge that we have specifically in Bellingham, and that's why you're seeing people like Skiers who's making a move from Bellingham to Blaine. It's related to the Growth Management Act and zoning. So if you, as an example, if you look at some of the parcels in Bellingham, the gross density of, we'll just take the Bakerview Nursery property as an example, is 300 and some units. Mm-hmm. We've had developers take a run at that, and it turns out that by the time you get everything through, after spending $50,000 or $75,000 in studies and preliminary meetings with the city and all of those things, the net yield of that, even though it's in the GMA as 300 units in terms of their potential future inventory, comes down to about 70 units.
Yeah, so, but that is essentially, all you've done is really confirm what I just said. And that is the fact that this is not a growth management issue. It is it's an issue of zoning within those boundaries.
Yeah, but that's actually in an area that has sufficient land mass, but because of critical areas, it's not in it's in the fringe. But they're using critical areas and things to effectively downzone what they have in as 300 units down to 75. And so that yield issue and the lack of making other appropriate properties available to compensate for that. So what I'm saying is there's potentially a significant reduction in the amount of available inventory in their 10-year inventory versus the gross inventory. See what I'm saying?
I agree. Yeah, and I wasn't actually looking at critical areas ordinances either. And then obviously then that brings in the very long, complex question of TDRs and whether you can get transfer of development rights, which is a way that you can try and address this. I don't want to get too much in the weeds, no pun intended. But you are, what you're saying is absolutely right. I think ultimately there need to be ways around trying to look at zoning and making it appropriate, because quite frankly, if not, then that is going to significantly curtail your economic growth. So, but Lyle, I couldn't agree with you more. You're absolutely right.
In Whatcom County and Bellingham specifically, infill is not the answer. There aren't enough places where you can actually infill to compensate for the need or for the 10-year inventory requirement.
Right. Well, that then gets back to buildable lands analysis, and I'm definitely not going to go down that road.
Right.
But you're right. David, you need to unmute yourself, Dave.
You have to unmute, Dave. Hold on one second. Well, he's
okay.
There you go. Go ahead.
In Bellingham, there are two things that stand in the way of your idea about flexibility in zoning, and one of them is neighborhood associations in Bellingham that have considerable political clout and will stand in the way of even the most minimal and reasonable projects.
Yes.
The other thing is what Lyle referred to, and that's the regulatory climate. And that drives development to the small cities in Whatcom County, and specifically to the small cities and not to rural Whatcom County, where the regulatory atmosphere is horribly restrictive.
Yeah, I think you're right. But again, it also, that to a degree actually plays into what I said earlier on, which is either individuals or groups of people saying, basically pushing back against any form of growth. So yeah, and you're absolutely right. And I think it's interesting when you look at it from the perspective of, you've got a great location up there. Now, as Lars said, I mean, quite likely it's infill, it won't suffice. I tend to talk, I have to talk on a little bit more of a 10,000 foot level than very specifically so. But the impediments there are not just topographic. They are without a doubt kind of political and geopolitical as well. And so we know that situations that, I mean, ultimately, I know that as far as growth management is concerned and GMA, we will not, those boundaries will not be extended. There's no way around it. I've testified and argued at the Senate any number of occasions, and there's no will to adjust them. And if there's no will to adjust that, then you really have to start looking within those broader areas to see how changes can be made there. But it's not going to be easy. It's not easy because of critical areas ordinances that Lal mentioned. That's an issue. There are ways around that with transfer of development rights. We know that, but that's a very complex issue as well. But beyond that, it's the broader, we're not going to be broadening the overall space upon which to develop. And if infill may not be the answer, well, we need to start thinking about other ways, because if you don't, then you will find those other cities like Blaine, like Ferndale, are going to become places that people are going to go to. Gary.
Something that you didn't talk about that I think gives me great concern is that the level of job reimbursement here compared to other counties is really quite poor.
What do you mean by reimbursement?
What you're paid, you know, how much people can afford to buy a house for has to do with, you know, what is our job market. And you talked about, you know, we're really heavily weighted in retail and in hospitality, and the really high paying jobs such as the refineries in Talco, which is closed. Even the government sector and the university sector are pretty flat, is making it so that your curve where you showed who can afford to, who's moving here, who can afford to move here, it's retired people who are selling their places for a lot of money elsewhere, and then they don't participate in terms of providing new jobs to our area. They're not paying a lot of taxes, and this is an area that government is basically a heroin addict. They're so dependent upon high taxes that people can't afford.
And you're right. You said you just said have a significant exposure both to hospitality and retail, and you're absolutely right. Those are lower paying sectors, no question. The university, I mean, don't get me wrong. I like Western Washington University. Go Vikings! But it's even if you're a tenure professor there, you're not making a whole bunch of money. Even though what is interesting to see is a lot of people over the last several years, student-wise, the student body population has grown exponentially. So a lot of people saying that UW, they don't need to do that, that they're heading your direction. And you're right. So that then makes it bifurcated, because you have those older population that can afford to buy, yet they're not actively participating in the economy per se, or that service industry worker who is working, but they're not being compensated sufficiently. And so you are missing, but to a degree, that middle grouping of people who are, it tend to be obviously for majority of them white collar workers, or even certainly some blue collar jobs if they're expanding there. But you are not unique. I can tell you any number of markets across the Western United States of your comparable size that are still seeing that breakup. It's either the people that've got a lot of money or people that don't. And that doesn't make for a fully rounded economy that anyone, or should be anyone's goal to achieve.
A question that was asked on the chat that I'm going to just relay is, what is the status of green initiatives, such as mandating homes convert from natural gas to electric? What does that do to affordability, and where do you see that going in terms of gaining legs in this blue government environment?
The issue on that, whichever side of the aisle you sit, is cost. It's as simple as that. It is remarkably expensive. And if it's going to come down the back, so certainly of developers, let's say on new construction projects, it's going to make it very hard. So I think it just acts as an additional cost center. But the broader question in terms of the adoption of it overall, I don't see that having much legs, certainly the legislature this year and unlikely next year. There's a lot more things to worry about right now based around budget than anything else. However, do I expect it to arise again at some point in the future? I do, but my biggest concern, and I know this because we see it already in California with the mandate, certainly for solar, is that it's very, very expensive. And the problem is for a lot of builders out down there, they just can't make sense out of it. So I think locally, I have issues with it purely based upon the cost, because that is a cost that has to be transferred across to the end user. That further negates affordability. But the bigger picture is I just don't see it really coming up anytime soon at the state level.
We have time for one last question.
Yeah, I've got unfortunately a TV interview I've got to run off to. Okay.
Well, let me stop there then. And very good program. I'm glad we got through the hecklers and figured out how to cut that off. That's the first time we've encountered that.
My advice to you to be when you put the invitation out, don't broadcast it. I know whether you were able to do that or not, but the times I've had this occur before, it was because somebody actually posted it on Facebook or something that a meeting was going on, and then you clearly know what happens when that occurs.
Yeah. Well, thank you for a really outstanding program.
Well, thank you for the invitation, ladies and gentlemen. I appreciate it. Hopefully you got something out of my musings. We are in an interesting time frame right now. However, I do, irrespective of the headwinds you have got up in Bellingham, as we have, quite frankly, everywhere, I think you have the ability and the raw bones to make something going forward, which will continue to expand, will continue to grow. But there are headwinds there which do need to be addressed, and hopefully your local elected officials, with your assistance, will be able to help to address some of them.
Thank you very much.
You're very welcome.
Any last issues from the group? I will bring this meeting to an end. Wishing everybody a happy Thanksgiving, a Merry Christmas.